Cool. Thanks for taking the time for this. Yeah, hi everyone. So this is the opening, I guess, webinar for Aztec 3, and going through the protocol, the architecture, and describing in depth what it is we're doing. And so I guess, so for this presentation, I want to take a slightly different approach, which is to go through basically why Aztec 3. What are we actually trying to achieve with this technology? What does it unlock? Who are the potential, like how does it potentially change things in a profound way? And how can we get from the current landscape in Web3 to where we want to go? So to start with, I just want to go through just a bit of a history of what it is we've been building, because there's a reason it's called Aztec 3 is because previously we've had things called Aztec and Aztec 2. When it comes to privacy on a blockchain, there are three major categories that are relevant here. There's data privacy, user privacy, and code privacy. And by that, data privacy is basically the actual information that you're transmitting on chain, is that encrypted? User privacies are the identities of the senders and the recipients hidden, and code privacy is can observers see the kind of the transaction logic that you are executing? And for one of the reasons why Aztec 3 is so exciting is because it has all these three properties, and I guess I'll try to explain why that's exciting in a bit. Also, when it comes to the actual kind of permissionlessness of the protocols, Aztec 3 is going to be the first one that is both decentralized, not centrally controlled, and also permissionless, where anybody can use it, and of course programmable. So what does Aztec 3 enable? At its core, at a very, very simple level, blockchains are extremely profound and revolutionary because they enable programmable digital money. You have an immutable distributed ledger of records of transactions where you as an individual, you can program what it is you even mean by money, as in the rules around transmitting it, the rules around creating it, destroying it, who can own it, who can't own it, and you can have ironclad confidence that transactions that are going across this network follow your rules to the letter without having to trust third parties. This is revolutionary. It's not something that we've been able to achieve before as a society prior to Bitcoin. And there's been a lot of hype and interest in blockchains because of what it could potentially enable. Things like distributed organizations, things like being your own bank was one of the original kind of rallying cries of Ethereum. Obviously, none of this has really turned out the way that people, the idealists hoped. But we think that there are some reasons for that, and I think that we can solve those reasons. Aztec 3 enables privacy-preserving programmable digital money, where you can hide both identities, you can hide values, you can hide the rules that you're applying around what is a valid transaction. And all these three things combine, they do enable something which is profound and transformational, but I think the obvious question is why, and I'm going to try and explain this by following the money. Hopefully this is large enough for people to see. This is a delightful psychological horror masquerading as an infographic produced by the Bank for International Settlements called the Money Flower. This is basically how central banks view cryptocurrencies, digital currencies, and digital money. This is their attempt to kind of categorize like all of the various forms of money as they understand it. Things like local cash, things like your deposits in a bank, which if your bank says you've got $3,000, that's not actually $3,000 printed by the US Treasury. It's something else. Central bank issued wholesale cryptocurrency is effectively it's currency issued to private institutions like banks, hedge funds, etc. that are used to do interbank settlements. But what I want to try and get to here is this is a bit of a mess, because all of these things, all these words, they are supposed to basically just do the same thing in an effect. They're a mechanism of exchange. But what is missing in this diagram is any concept of privacy. This is how central banks think the digital currency landscape is going to evolve, and if they are correct, then what we are doing is we are creating a technological dystopia, because it means that every single thing that you do, or like with your money, with your payments, will be trackable on digital ledgers that are completely transparent, and for most of these cases, they will be centrally controlled by a bank or by the central bank. What we are doing, the kind of the industry that we operate in, is reserve this tiny little space in this so-called money flower. And so yes, this is I'm not going to waste any more time on this, because this is a very strange way of viewing the cryptocurrency landscape, but I wanted to show it to show you what the current consensus is on how digital economies work, how digital money works. But we can do better than this. We can do a lot better than this. So this is a diagram that I cooked up, which is basically how I think the future economy based around digital assets is going to look, based around distributed ledgers, permissionless cryptocurrencies. Or at least this is a potential model. And I use the word here asset, not money. Normally, there's a clear distinction, because there's an expectation that money is very, very liquid and can be used as a mechanism of value exchange, and an asset is usually illiquid, not particularly fungible. One of the reasons why people are so excited about blockchains is because blockchains can, in theory, break this paradigm. Once you have tokenized and digitized assets and put them on chain, you are able to interact with them via programmable contracts in a very composable way. Where, for example, if somebody creates imagine you have a digital, some financial instrument, let's just say it's a mortgage, and it's sitting in the bottom filing cabinet in the basement of some district bank. That's not a liquid asset. But if you tokenize that asset, if you then, all of the information that trades with that asset is publicly visible and transparent, and you have a digital representation of that asset that that is fungible with an enormous ecosystem of other digital assets, it changes things a little bit. I would argue, I'm not an economist, and most economists would likely laugh at me for saying this, but I would argue that in the future, the distinction between assets and money is going to be a lot looser than it is today. Anyway, let me describe what happens. What I'm trying to describe here. I think that there are three very useful kind of buckets that you can put crypto protocols into. There's whether it's universally accessible, so like can anyone with an Ethereum address access this stuff? Does the protocol or asset rely on some concept of off-chain identity, or does it rely on privacy? I'm going to use identity and privacy quite interchangeably in this presentation, because meaningful on-chain identity solutions require privacy. And finally, there's the oracle dependence. And by an oracle, I mean, are you reliant on some off-chain source of information for your asset to make any sense, or are you reliant on external actors that you have to trust to some degree? As in, like, for example, if a DAO has a treasury that is off-chain, and they appoint a financial director to manage that treasury, then I would argue that that's some form of oracle dependence if you have an on-chain representation of that treasury, because you have to basically trust that those two align with one another, and the way you trust that is through trusting the treasury manager. The oracle problem is quite severe in crypto, where basically the goal is for everything to be completely decentralized and trustless, but actually a lot of the more complicated protocols do rely on oracles in some way, even if it's as simple as something like Chainlink. But one of the reasons why, like right now, I would argue that down here, where oracle dependence and identity dependence intersect, this is where all the money is. As in, this is what I refer to when I mean externally originated digital assets is I'm talking about mortgages, bonds, loans, basically the entire ecosystem of traditional financial activity that doesn't happen on chain right now could, in theory, be captured by this section. There is nothing fundamentally stopping Ernst & Young, for example, from originating all of their loans on a permissionless blockchain, other than obviously they're not going to do that. But if you had privacy, in theory, you could. There is no fundamental reason why you couldn't. And one of the valuable things that privacy does is it enables an enormous amount of composability between multiple different types of asset classes that rely on different trust assumptions in a way which I think is not really being captured by the Web3 community development. And where I think the really interesting thing happens is when you intersect, this like oracle dependence with universally accessible and dependence on privacy. This is where I think we are going to have an enormous explosion of applications and products and services that are going to fundamentally disrupt how we as a society manage finance. I'm going to try and explain for the rest of this talk why that is, and why I've labeled this category institutionally disruptive DeFi. But the model is, if you have on-chain privacy, you can meaningfully bring external assets on-chain. You can create digital representations of brick and mortar buildings, of assets, of liabilities, because you can meaningfully tie those to identities without splashing an enormous amount of information on the blockchain that observers can see. And this is very, very fundamental. And those assets, once they are on chain, they can then be interacted with by protocols that are far more permissionless. Basically, what I've called here institutionally disruptive DeFi, where I think value is going to accrue. I'd probably just I'll be throwing out a lot of jargon at the moment. So why don't I stop for questions before moving on? Okay, I'll move on then. You guys can hear me, right?
Yeah, we can hear you.
Okay, great, cool. So yeah, what the frick do I mean by institution disruptive DeFi? Here's an example of the applications that are happening in this circle. Quasi-bank deposits. They're not really bank deposits. They're DeFi protocols that are basically pretending to be banks. They're taking in equity from users, and then they're using it, and then they're investing them in other DeFi protocols. Financial services like consumer finance, where you need some form of identity to do KYC. Basic payments and subscriptions, things like DAOs that perform fund management, and this is the category which is going to be absolutely game changing. Which doesn't have I don't think it has a proper name, so I gave it one: artisanal asset origination. I'm going to explain what that means in a little bit, but it's the idea of creating financial instruments from scratch, originating them, assets. But doing them as without the institutional weight and requirements of a large financial institution, doing it as more of a boutique shop. Here's what I think the end state of our digital economy is going to be if we succeed with Aztec 3. I think that if you have a private programmable distributed ledger, if it's when executed sufficiently well, with enough transaction throughput, with enough ease of use, you can use that ledger to originate the majority of the planet's value. Okay. I'm being slightly hyperbolic here, but in terms of scale, I genuinely am serious. You can settle a majority of the planet's transactions, and the majority of existing paper assets can become cryptocurrency assets with all of the liquidity that it brings and all the value that brings. If you have composability and programmability of crypto assets, you change the game in a dramatic way, because I really cannot describe, I think, just how important it is to have, how much of a game changer it is to have this distributed ledger where you can program, you can program what do you mean by a valid transaction, for your own digital asset. And then you can program in rules and logic around interacting with other digital assets. It really is something which hasn't existed before in our society. So for example, one of the ways of thinking about it is, imagine you have a deposit in a bank. Imagine you put £1,000 in HSBC. What can HSBC do with that £1,000? Their ability to generate yield on that fund is limited, very, very limited by the effectively peer-to-peer interactions that they can perform with other banks and financial institutions. You have an enormous amount of communication complexity with the existing brick and mortar structure that we have for handling money. That completely goes away with a blockchain, because you suddenly have a completely open architecture where every single kind of form of digital money can interact with every other form of digital money. It is, anyway, that's a bit of a tangent. But one of the effects of this is it makes assets that are illiquid at the moment, it makes them extremely hyper-fungible if you digitize them, because there's nothing, because you have all the information required to trade them or to package them up in derivative instruments. And if you can make illiquid assets hyper-fungible, then your need for liquid currencies decreases, right? Like, why in a financial market, why do you need pounds? Why do you need dollars? Well, you need some kind of form, like some liquid representation of value, so that if you want to exchange asset A for asset B, if I want to sell $1 million of mortgages and buy $1 million of government bonds, the person selling those government bonds isn't going to take my mortgages as payment, right? I have to exchange them into dollars, and then I have to convert this, and then I have to give those dollars to the guy, to my buyer, to my seller. If the assets themselves become fungible, then the actual need for that for ready liquid capital decreases substantially. And this is very important, because this is the justification for so much leverage in our existing financial markets. So, like, what happens when you put a deposit in the bank? Like, if I put £1,000 in HSBC, what HSBC is going to do is they're going to leverage that, right? They're going to create about $10,000 of liabilities and $10,000 of assets. And in doing so, they are going to massively inflate the money supply. And leverage, whilst it's an unpopular boogeyman because of the dramas around 2008 and the fact that it can get out of hand and you can overheat your economy, like doing this kind of thing, it's extremely important. If you didn't have leverage, you wouldn't have the liquidity required for our modern financial system to work. But if you can make the assets themselves almost act like money, then you need less liquidity, which means you need less leverage, which means you need less fractional reserve banking, which is what I was describing. And if you don't need that, then the actual entire reason for large financial institutions and banks existing in the first place starts to erode away. And that's why this is extremely important. Like what looks like a very weird niche property of what we're trying to do here, like making liquid access hyperfungible, why that is actually a monstrous monumental game changer. And what the hell is artisanal asset origination? This is when a small outfit specializes in a specific asset class and is generating them. So I'm talking about the common example is things like a mortgage or a corporate bond, but it'll be far more like niche than that, like shipping, insurance, loans, or things like that. You've got a small outfit with run by like a small number of experts in a particular niche, and they are not working in a bank. Normally, somebody like that will be working within the confines of a large financial institution, and they will be getting their equity, their money, for creating these assets. They'll be getting them from the bank and from consumer deposits. And again, the bank will be providing the market through their trading desks. But blockchains break that. Instead, this small outfit doesn't need the institutional weight of a bank. They get their equity directly from consumers on chain via peer-to-peer DeFi, and they get their market for their assets via DeFi again, and via DAOs, via on-chain consumers. This is kind of why people sometimes refer to Ethereum as a global settlements layer, because this is what they're referring to. It's not just the act of trading around money. It's the actual act of creating financial assets and having the actual the record of what that asset is. The primary source of that being a blockchain. This is existentially disruptive for TradFi players, for large institutions, because it kind of erodes their entire reason for existing. Again, just like the need to unwind leverage. if you don't need the institutional weight, the vertical integration of a large finance institution, instead if you can replace that with the network, the network you get from a blockchain, then effectively what you can it can create an exodus from these banks where the individuals within those institutions decide to leave, to band together, create their own startups, and effect like that to perform this asset origination and effectively slay their former masters. And this is what we want to try and achieve with Aztec. Yes, getting to Denmark. So what I've just described here, I've described an area where, like, the majority of the planet's value will be originated on a private programmable distributed ledger. And I'm just going to replace that phrase with Aztec 3 because we're going to be the first, we're going to be the best. Like this is some like pretty wild stuff I'm talking about here. I'm talking about like removing the need for banks and for leverage and having everything being traded and settled on a blockchain layer that we're going to build. This is a long way away from where we are at the moment. If you think about Aztec Connect, we can handle about 1 transaction a second, and it's not programmable. So the way I say it, so something that sociologists and political scientists often say is how do you get to Denmark? Because Denmark is a country with an extraordinarily high standard of living, a strong social safety net, and a very high trust society where people trust their government institutions, and like generally quality of life is extremely high. And so a lot of sociologists are like, how do we get to Denmark? How do you turn some a developing country into Denmark? So basically, how do we do the equivalent for Web3? How do we create this world where you have like this frictionless, amazing, high quality financial services available on a private blockchain compared to where we are today? Because the current ecosystem is underdeveloped, it's not mainstream, and it's missing key institutions to pull this off. And so how do you get from where do you start? How is, if we imagine we release Aztec 3, so you've got this network now where you can program smart contracts and you have private state. How do you get from there to executives in Goldman Sachs, like waking up in the middle of the night, in a cold sweat, worried about Aztec eating their business? Well, the first thing we need to do is actually work on institution building. The help to incubate and develop the institutions that are going to be driving this extreme change in how we perform finance. Particularly like things like these small outfits that are originating assets, all of the individual components you need to basically recreate a TradFi ecosystem, but on chain in a permissionless manner, where every single individual component is actually its own protocol operated by its own team, and it's not vertically integrated into a financial institution. Well, we can start with DAOs. Because right now I don't know if there's a word for it. I've noticed a few, this oracle trap that a lot of DAOs are falling into lately, where a DAO will I'm thinking things like MakerDAO or Aave. They'll raise a treasury to do some innovative DeFi project. So for example, MakerDAO, they've got a dollar-pegged stablecoin that doesn't collateralize with US dollars. Very cool, but the demand for DAI massively increases the need for people to create these collateralized debt positions in the MakerDAO ecosystem, collateralize Ethereum and generate DAI. You can only generate DAI if you're back in the early days, if you collateralize Ethereum. And the problem is the supply of Ethereum is capped because the overall amount of Ethereum available is relative to our financial ecosystem. It's absolutely tiny. And it's intrinsically linked to the value that people place on the consensus of the network. And so in order to generate more DAI, Maker started collateralizing off of other assets, things like USDC, which became very, very unpopular because then they collateralize on assets that rely on oracles like Chainlink. And this became quite a lot less popular because it undermines the stability of the price mechanism, because now you have a lot of correlated risks. You have to trust that the USDC won't blacklist DAI. You have to trust that the Chainlink oracle isn't going to go down. And if these things happen, then DAI is going to depeg. And DAOs that go down this route of having to rely on more oracle-based assets, they start looking like a TradFi shop eventually. You've even got, I think, was it Aave or a DeFi protocol like that wanted to do some of what I'm just talking about. They want to bring more liquidity into the Ethereum ecosystem by tokenizing off-chain assets. But the only way they could do that is by creating an off-chain trust that held the assets, and then just like created a digital token where there was some kind of vague claim that the token represented a claim on the assets in the trust, but there wasn't actually any legal backing to that, and you had to just trust the fund manager. It's exceptionally weak, and the reason why it's weak is because you cannot put the required information that fully defines these off-chain assets. You can't put that on chain without strong privacy guarantees, because this is just far too much sensitive information in that data. You can't do it without linking the asset to an identity, and so we can help this. We can. I think one of the low-hanging fruits for Aztec 3 is basically enabling DAOs to work with off-chain actors to tokenize off-chain assets. We know there's existing demand for this. Like, companies are trying to do this today. Like, DAOs are trying to do this and failing and going under because they can't pull it off. But we can create a world where the primary record of the asset's credentials can be on chain. The idea is, you could have some tokenized, I don't know, like you could take some government bonds and you could tokenize them, and all the information that describes what those bonds are and how they're trading, etc., that would be on chain. The holders of it will be on chain, like their identities, but encrypted. And you could create audit proofs to prove aspects about these like the links between on and off-chain assets, to prove that they're related to one another. You can, instead of having to blindly trust a fund manager to act in the interests of the DAO, you could actually, any kind of movements of those assets, you could come accompanied with an on-chain proof going, like, I have the credentials to perform this action because I've been authorized by the DAO. And you could do all that and do all the required credentials checking without leaking sensitive information, by making it all a noir contract. And this is what I would consider to be low-hanging fruit. I mean, I suspect if we execute well on Aztec 3, we as a company will not have to do anything to get phase 1 finished, because it just solves an existing problem that organizations have. And phase 2 is of this loose plan I have in my mind is moves to asset origination. So what I was talking about before was taking existing off-chain assets and creating tokenized forms of them on chain, so that you can use them as collateral. With phase 2, I'm talking about actually genuine, like creating financial instruments, financial assets from scratch, and having the primary record be a blockchain. This is what we were trying to do originally back in the early days with creditment. We were trying to like syndicate corporate loans and put them on using Ethereum a long time ago. This is if you have a DAO that already has tokenized off-chain assets that's managed to summit the first phase, then this is a big no-brainer thing to do, because the DAO will have existing capital to originate those assets if they want to create some loans off-chain. They have existing capital from users in the token, and that using such assets as things like collateral for something like MakerDAO, there's a much lower trust threshold than tokenizing an existing asset, because the DAO as an institution has complete control over the origination process, and it reduces. You still need to trust off-chain actors, but all of those off-chain actors are now actually acting are effectively employed by the DAO. So the trust barriers are much lower. Phase 3 for this is consumer finance, because imagine now you have an ecosystem where you have DAOs existing on chain that are creating financial instruments. They're creating loans that exist off chain. They're using their on-chain equity to create off-chain loans, and they're tokenizing those loans and using those as collateral, at least the liability. The asset. I would argue that this is going to happen. If someone pulls off a private privacy preserving blockchain, this will happen, and this ecosystem growth is going to drive demand for equity, right? Because if a DAO is good at doing this, then that means that you're starting to get like on-chain yields, right? If you have a DAO that's creating off-chain loans with their on-chain funds, then the assets that represent those loans, they're going to be generating yield, and that's going to drive demand for so there's going to be demand to do that. But then that's going to then drive demand for equity, basically like more consumer deposits to originate more loans, to generate more yield. And this is going to drive the need to produce value-added services, because now these DAOs are going to have to actually attract, work to attract user deposits. And this provides an opportunity, a golden opportunity for wallets to level up and actually supply value-added financial services to consumers via Aztec 3. Basically attracting deposits from users, because those deposits are going to be going to a DAO. They're going to be then used to originate assets, and those assets will be earning yield that will be going back to the wallet and back to the user. Effectively, what I'm describing, it's banking. I'm describing banking, but I'm doing it in a stupid engineering way. But like, does this make sense to folks? Like basically, what Aztec 3 enables you to bootstrap from scratch, meaningful banking services in a financial ecosystem that exists on chain. And the fundamental missing keystone for this all is privacy, because without privacy, you don't have identity. Without identity, you don't have the required capability to actually originate off-chain assets, but make the primary source of record live on chain. And then once you have this, once you have this little bubble where you've got these DAOs that are kind of tokenizing and originating financial assets, and you've got these wallets that are providing value-added services to users to attract deposits, because then they can be used to generate yield, then you're going to see a diversification of the industry. Because the main barriers to once something like Aztec 3 exists in the world, the main barriers to pulling this off are execution oriented. It's just hard to do, right? Like, there's a lot of tech that needs to be built. There's a lot of, you need to coordinate between the technical layer of the DAO, and that DAO now needs like real world actors to make this all operate. But once this has been done, then it's going to be a lot easier for a second wave to come in, because the fundamental barriers to entry for doing this is going to be very, very low compared to TradFi. And so you're then going to see a very rapid, I would argue, diversification of all the asset classes that are being supported and created, and the services that are being provided, as organizations are seeking a competitive advantage to attract more capital, to get a better yield. So in a way which is far more competitive than our existing financial industry, because there's more, because the barriers to entry are so much lower, and the friction is less, and the efficiencies here are so much greater because of this. The composability between protocols and assets. It means that small outfits can actually make a meaningful impact and provide useful services without having to rely on the institutional heft of a bank. So this is would be quite a this world. Already we're at the point where if this gets pulled off, this will be happening on Aztec if we execute well, because quite frankly, it can't happen anywhere else. No other proposed privacy network has the kind of the technical capabilities to code up smart contracts that can actually handle this kind of complicated logic. And we have unique advantages by being linked to Ethereum, because we already have a steady source of capital liquidity to bootstrap these kinds of protocols, because liquidity, like Ethereum, has the most value of any blockchain that's kicking around. So where do we go from here? So phase 5 of this is what I call political bullshit, because I'm being very idealistic here. Ultimately, right now, if you try and create a financial instrument where the primary source of record is information on a blockchain, and then let's say that, so let's say you've created a loan, right? Like, you're doing peer-to-peer finance. So, so you've got some website where people are taking out loans, and you're putting them on chain, originating them on chain, and you're creating some token on chain, which is generating yields based off of these loan payments. Then if users default on that loan, I'm not a lawyer, this is probably on for Andre, but I doubt that you can go to, say, the High Court in the UK and go, oi, according to the terms in this blockchain smart contract, this user is defaulting, and therefore we need we're going to claim the collateral. I doubt that's there is an enormous amount of precedent that needs to be established before that can happen, and a lot of lobbying that needs to happen, and a lot of potentially even legal law changes. And until that happens, then you're going to have to even if you want to use the blockchain as a primary source of record, you're going to have an on-chain source and some trust in an oracle to make sure that the on-chain record and the off-chain record are match one another, which isn't ideal. So we'll need to lobby to change laws and set new precedents. But if we reach this stage, then I don't suspect this will be difficult, because we'll have a large number of allies in this endeavor, because the ecosystem, the industry you're working in will be much larger than it is now. And there's going to be a lot of money at stake, and a big first mover advantage for any country that adopts more crypto-friendly regulations, so that you can do things like asset origination on chain. And then what's the last step of this? The last step is now, like, if you thought I was talking about completely wild stuff before, now I'm talking about complete space station, because I'm talking about what you really need for this whole system to wrap a bow on this whole financial ecosystem that's being bootstrapped. You need a reliable source of on-chain liquid currency for value transfers. I was talking before at the very start about how hyperfungibility reduces the need for liquidity, but it still exists. And things like USDC, they're pretty inefficient and they're centralized. You have to ultimately, it's like the actual store of value is it's collateralized dollars. DAI, you have very low trust because of price volatility. You're not going to be doing like $1 million trades with DAI or $1 billion trades. The ultimate solution is to basically have what banks have today, which is a direct line to a central bank, where a central bank will directly print currency and give it to financial institutions. I'm talking about a central bank digital currency, but not a crazy techno-dystopian one where a central bank is running their own little blockchain fiefdom, but one where a central bank has the stones to actually print their currency directly on a permissionless ledger like Ethereum. This is not going to happen anytime soon, but I would argue that one day, if we execute well, if we succeed, if we create this vibrant, dynamic ecosystem of financial assets, instruments, and services on the blockchain, I would argue that this will happen, because the first mover on this genuinely can make a play to become part of a global reserve currency. Genuinely, right now, imagine right now if you had Swiss francs on chain. Imagine the Swiss central bank was printing francs on Ethereum. One thing that would immediately happen is that MakerDAO would use Swiss francs to collateralize, to create a large number of collateralized debt positions to increase the supply of DAI. And effectively now what you've got is a dollar stable coin, which is backed by Swiss francs. And that's just one example, but basically having base money from a central bank on Swiss blockchain would be revolutionary. And given the amount of value that would be generated from that, I do genuinely think this is a question of when and not if, but it will take a long time. So I guess to summarize, what I'm talking about here, I know this has been quite being very off-piste. I've not been talking about technology. I've not been talking about things like the existing Web3 industry. I've not been saying you can use Aztec 3 for games, for NFTs, and for private voting, things like that. And you absolutely can and we will be using them for that. But this, I want to describe, I think, why Aztec 3 is not just cool. It's not just valuable, but actually utterly revolutionary if we execute on this and pull this off. Because if you have privacy, you have identity on chain, and if you have on-chain identity, then you have a way of getting off-chain assets on chain. And once you do that, you get this insane cycle where the ability to do that and generate yield generates a demand for capital, and then the demand for capital generates a demand for yield, and the demand for yield generates a demand for putting more assets on chain, and you just cycle around and around until basically Aztec becomes the world's global settlements layer, literally. That's what's at stake. And so yeah, this is why I am excited for Aztec 3. This is why I've been involved with this in this industry for 5 years, and yeah, this is just having private programmable money. It changes everything, and it's going to be an absolute moonshot to execute on this. Executing on Aztec 3, shipping Aztec 3, that's not a moonshot. But then actually aligning things so that the network is functional enough to execute on these ideas, and being able to attract creating the ecosystem of developers and users that make this happen is going to be very hard. But I do think, genuinely, hand on my heart, this is possible. And so yeah, this is my answer to why Aztec 3. So yes, questions? Yeah. So hopefully that wasn't too off the wall and hard to follow. But do folks have any thoughts or questions about anything I've said? Okay, I'll ask a question of mine then. Do folks here have a clear understanding of why we're building Aztec 3? Like, did what I've described make sense, or did it just sound like the ramblings of a deranged lunatic?
I think it makes a lot of sense, Zach. And I like the emphasis you put on the social pieces that follow the tech. And I've seen this a lot with just like Ethereum of like, there's a lot of really smart people building really cool tech, and the tech moves really quickly, but we have to move at these like on these social scales as well. And like just winning hearts and minds takes a lot longer than like building brand new tech in some ways. And that's a substantial part of realizing the vision is like this social layer. So yeah, just like keeping that in perspective is helpful, because like I've been talking about Aztec 3 a lot and basically saying, oh, in the next 18 months, we're gonna like make substantial progress towards getting to mainnet, but like really that's like one step on a much larger journey. So yeah, we've got a big project ahead of us.
Yep, absolutely. I think I was talking about in that slideshow, phases of execution. What I didn't say is phase 0, launch Aztec 3. So we have a lot of work to do. Yeah, Kobe, what's up?
Hey, and I think the question that's probably been asked around a couple of times, but I wonder about quantum computing resistance of the crypto algorithms you're going to be relying on.
Yes, very good point. So quantum resistance, does it matter? Are we afraid? What are we doing about it? So there's two parts of the quantum resistance. There's, if you have a cryptographic protocol, then can you create fake proofs if you have a quantum computer? And can you break zero knowledge if you're a quantum computer? So basically, can a quantum computer, imagine you have, the Aztec ledger, and it's, transactions are going through it, and obviously the historical state of what's happening in Aztec will be available. So once a quantum computer turns up, can it then just decrypt everything in the chain and go, ta-da, look at what everyone's doing? And the answer to that is no. Even though our tech is not quantum proof, I think it's sometimes called quantum resistant, which means that you cannot, a quantum computer can create fake Aztec proofs that will satisfy a verifier. But what a quantum computer cannot do is decrypt old data. And so this is useful because it means that, I do make several assumptions around quantum computers. One of them is that we will have a lot of warning time to switch to quantum proof cryptography before a quantum computer comes online. I think that this is a fair assumption to make, basically given like the pace of developments in quantum computing, and also the fact that if you do have a quantum computer like today, if you had a quantum computer today that could break elliptic crypto, you don't have to worry about Ethereum. You have to worry about the entire world's financial ecosystem falling apart overnight, because everything, like every form of digital electronics transfer, relies on crypto that can be brokered by quantum computers. Like, when you sign a transaction with your debit card, like you do contactless payments, like that's an RSA signature. When you're logging onto your banking app, right, like that's all this digital signatures. They can all be cracked by a quantum computer. So I do think that we will have warning before quantum computers become a real threat. We'll be able to see every single major bank and financial institution stampeding for the door, updating their crypto, and so we will do the same. Right now, quantum proof crypto is not fast enough, performance enough to pull off what we want to do. That will change in about 5 to 10 years. So yeah, we'll just switch over. The old state won't be able to be decrypted, and yeah, so I think it'll be secure.
Is it a property of the encryption that enables that, or yeah, like how does that work, or is there anything
So
we
it's
can
okay.
read on that?
So the thing is about so if you think about elliptic curve commitment, it has properties. It has two properties: it's hiding and it's binding. By hiding, we mean that you cannot recover the original information without a decryption key, and binding means that that original information could only produce that commitment that the specific committee had. So if you want to encrypt, hello world, you'll get a specific elliptic curve point depending on your commitment scheme, and you can't get a different one. So the hiding property stays with quantum computers, but the binding property breaks. Basically, what happens is that you can sorry, I messed up the definition of binding. Binding is basically if you have two different plain texts, they can't produce the same ciphertext. And hiding is given a ciphertext, can you find the plain text? And so what quantum computers do is it basically means you can break the discrete logarithm, which means that you can make like elliptic curve cryptography relies on being able to not be able to create like the way it works. Sorry, yeah, it's seriously properly. So a simple commitment like a pedestal commitment is basically you have two elliptic curve points. You have two things you're multiplying points by, a secret and the information you want to encrypt, and you combine the two. If you know this discrete logarithm, then you just have a very simple equation. Basically, you have a x naught plus b x1, where x naught and x1 are basically like secrets encoded into elliptic curve points that nobody knows unless you have a quantum computer. But if you have a quantum computer, then you know what x naught and x1 are, and therefore you can mess around with the values a and b to be whatever the hell you want. Which basically means that you can make anything, any input data you can make look like any encryption. So you break the binding property quite dramatically. But because of that, it also means you don't break the hiding property because you still can't map backwards. What it means is you can take an arbitrary number of different input plain texts and produce the same ciphertext. But because of that, right, you can't take a single ciphertext and then map that back to a single plain text because it could have come from any plain text. It's I think that was only a partial explanation. I think I might have got a couple of things wrong there, but
I think that was
It's a bit.
yeah, so
like cat, if you encrypt cat, dog, and something else, like with a quantum computer, they'd all look like the same thing. So basically,
you can make them look like this.
Yeah,
you can make them look like something.
Yeah.
So if someone's decrypt, go ahead, Kev.
I was going to say commitments just binding or hiding, and then you can have this additional property where it's perfectly binding, or perfectly hiding, or computationally binding or computationally hiding. It can't be both perfectly hiding and perfectly binding. Because if you perfectly bind it to something, then you can't hide it because you've perfectly bind it to one specific thing. And quantum computers can break this computational binding property. So pedestal commitments are perfectly hiding, but they're not perfectly binding.
Got it. Yeah, so it's like if I had some secret that I didn't want the world to know, like, and the quantum computer was like, okay, this is just secret. I could also be like, no, this is my secret. No, this is my secret. And it's kind of like you'd have like 10 versions of the secret, so you wouldn't know which one was the secret.
Yeah, but it's also that if you encrypt something with that secret, a quantum computer can't figure out what you encrypted, because Cool. Yeah. Anything else on folks' mind? I know we're running way over. Sorry about this, Joe. I'm bleeding into your time.
Yeah. What do folks want to do? Do we want to schedule like kind of 45-minute slots, or do people have time? And yeah, do you want to reschedule the decentralization one? What's people's calendars like? So I know we only had the engineering workshop time slot.
I think maybe. Oh well, the answer is maybe we reschedule until next week, and maybe we can just chat with presenters and see whether they want to produce more content than 15 minutes. Because I think Zac's was really good, and it was good to have 45 minutes. So I'll catch up with Bruno. Maybe we'll make future sessions slightly more flexible.
Cool.
Yeah. So let's reschedule.
I've got about probably 20 minutes, I reckon, if we go deep on some areas. So and then questions. So I think getting at least there'll probably be more questions than content, I think, which will be good to have so people learn.
Cool. Let's try and reschedule it for early next week.
Awesome. Sorry for being a time hog.
That's all right. It was great.
Cool. And yeah, if anyone has any questions, just message on Slack. Yeah. And yeah. Cool. Thanks for listening.